Good afternoon, good morning, good evening, good night. I've got some people in different continents as well as different states. Thank you for joining us for our Q3 market update. Again, we're grateful for the time you'll spend with us today. Just as a quick update, today we have three guest speakers. I'll kick off a discussion on U.S. equities. Madeline's going to cover macroeconomic developments, and Tom's going to have both international and fixed income. So we'll dive in here. Just a little bit of background for Breakwater Capital Group. For those of you who are not familiar with the firm, we were started in 2002. Today we support about 180 clients all throughout the United States and a couple of clients abroad. We have three main offices: an office in northern New Jersey, an office in Dedham, Massachusetts, and an office in Denver, Colorado, where Maddie's joining us today in the morning. We want to call out or cite our various sources. We're fortunate to have a lot of content available to us from the likes of Charles Schwab, JP Morgan, FMRCO, Apollo, so on and so forth. So again, while we can't provide the specific information itself from these various reports, we will make available some of the content. Why don't we go ahead and kind of dive into the recap for the third quarter. After really three strong quarters in a row, we found ourselves in an environment where capital markets were pretty much weak across the board, right? We saw U.S. equities give back some of their gains, as well as bonds after a decent start to the year kind of give back as well. So what really precipitated that was, Matt, if you want to hop to the next slide, was a more hawkish Fed than perhaps a lot of people had thought to be the case. That they had a hike in July. They had taken the month off in August for their Jackson Hole confab, and then paused in September. But what was released in September were their statement of economic projections, which again spoke to the idea that maybe aggressive cuts are not in the cards for 2024. Again, they still intimate that there's a possibility that further rate hikes are in store. We'll leave Tom to take us through the rate environment in a bit. The consumer keeps defying expectations and odds, frankly. Again, we keep being told that the pandemic era savings have been spent down. If you saw the retail sales numbers today, which are for the month of September, that clearly isn't the case, as numbers came in about 2 times what were expected. So that's a positive or encouraging story, especially for an economy that's so much driven by consumption. Again, nothing surprising here, folks, relative to dysfunction in Washington. While we averted a debt ceiling debacle in the summer, right, that was one of the highlights of our Q2 report, and we avoided a government shutdown. We had a fiasco in the House, and that's still to be resolved. We'll see what happens over the coming days. Interestingly enough, despite the fact that we experienced losses pretty much across the board, which we'll get to in a little bit, volatility is actually somewhat benign, which is, again, somewhat strange in the face of some of the geopolitical issues, coupled with, obviously, a higher rate environment, especially with rates having moved up so quickly. So we'll talk a little bit there. The one place we did see, fairly significant liftoff was in commodity prices, not specific commodity prices, I should say that. Really, energy prices, oil in particular, bounced quite a bit in the third quarter, which again kind of fed into the inflation narrative. It is heading downward, right? We unfortunately saw a little bit of stickiness last week in the CPI, specifically around the shelter, right, which is housing. But again, directionally, inflation seems like it's coming off. Excuse me. The UAW strike has been, on the headlines, right? We haven't got a resolution there quite yet, but the good news is union labor is a very small percent of the population. I sent a piece out maybe in late August or September. The UAW accounts for 0.1% of the working population, and we're talking about striking to the tune of about 1% of the workforce. Now, obviously, suppliers and other people who are impacted by those strikes are going to feel that impact. However, again, I think it's a good headline. I'm not sure it's necessarily influencing the labor markets too much so. And we continue to see, a somewhat confusing picture out of China. They've continued to, try to stimulate at the margins, but nothing really that's been all that productive with respect to, getting people back to spending, and trade flows have slipped a bit. So before we kick off to Maddie to take us through the macro update, I'm going to just, go ahead and show you kind of a summary of, asset classes through the third quarter. So Matt, if you want to see that slide. We can see again, only positive place really was commodity and high yield bonds. Again, high yield bonds kind of a laughable thing because distressed debt shouldn't be doing as well in the face of higher interest rates necessarily. But there's some a significant amount of exposure in the high yield space in the commodity complex, which again kind of gives a reason why odds of default have diminished somewhat and why they rallied. But again, across the board, you're seeing returns in the low single digits in the negative territory, with the worst being long-term bonds. And again, that's because rates moved up from like low threes in May all the way to as high as 480 at the end of September. I want to call out this piece on the bottom. It's kind of cool. At least I think it's cool, right? It looks at 20-year rolling returns for equity markets. And you can see that, going back to 1946, equities, generally speaking, had only provided about a 5% incremental additional return on a rolling 20-year basis, right? So let's say rolling 20-year stocks average 10%, bonds average 5%, right? Now we've seen this phenomenon where bond yields have come up so much that the prospects for that gap will probably shrink a little bit. So we'll see what happens in the coming years. But again, just kind of interesting that well stocks have outperformed fixed income going back to post World War II. Maddie, I'll turn over to you to take us through the macro.
Nice to have everyone here today. So first thing that we always check in on is the employment picture. And we can see here that over the past 50 years, unemployment, which is in that gray line, has been at an average of 6.2%, while wage growth, which is in the blue line, has been at 4%. And you can see here that they tend to have an inverse relationships, and high unemployment is usually, the result of an economic downturn or recession. But right now, unemployment remains below the long-term average at 3.8%, and wage growth also remains above the average, sticking at 4.5%. Very similar to what we saw last quarter. This slide would indicate that the job market is still on really solid footing, with slightly lower numbers, but similar as compared to last quarter when we presented the same slide here. And if we look at labor a bit more closely, we see that non-farm payroll, because it's one of the key indicators of the state of employment and the economy, and has a lot of influence on monetary policy set by the Federal Reserve. We can see here that in August, payroll gained 187,000, up from the 3-month average of 150,000. And while still positive gains have been trending down, as you can see from the gray line in November of 21, as we further recover from the pandemic and later labor continues to get tighter here. So if we look at the graph on the right, we see the labor force participation rate trending up before COVID, with both age groups, 25 to 54-year-olds in the lighter blue, and age groups of people ages 55 and up in the darker blue. Then it came down significantly, during the pandemic, but is now etching back up to those pre-pandemic trends, with the younger generation participating slightly more than anyone ages 55 and up. We would expect to see that gap continue to narrow. And if we move on to looking at the labor market indicators on the bottom of the slide, we see the economy recovering in 2021 and into 2022 in multiple areas, with a cooling off in 2023, moving into more of that neutral territory, as the effects of the tighter monetary policy certainly are making its way through the markets. Manufacturing, services, and small businesses are neutral ending in September, whereas jobless claims and continued jobless claims are continued bright spots. The services sector has been a stickier place for inflation, but with higher rates, we're slowly seeing that soften. This graph is certainly highlighting that on the bottom there. Softening signals may indicate that rates have risen enough to cool the economy, but that still remains to be seen. And as we look at this next slide here, continuing on a cooling theme, it's interesting to see that job cuts in the graph on the right have increased from 2021, bouncing back and forth between the 100 to 400 level, with a decrease this year and a trend upwards. But the jobless claim in the graph on the left edge lower, trending down since 2021, and looking to possibly dip below the 200,000 level as 2023 progresses. This would indicate that even as people are laid off, they're still able to find new positions, signaling that a significant spike in job cuts over the past year hasn't quite led to a meaningful increase in initial jobless claims. And now if we look at how that's affecting businesses and consumer confidence, we constantly hear that consumers are feeling negative when it comes to the economy, but we also like to get a pulse for how businesses are doing. And you can see from the graph on the left that small business capital spending plans in that darker blue have trended lower over the past year, and non-residential investment hasn't picked up much as indicated by the lighter blue. This signals small businesses' capital spending plans may not be expanding in business investment. And if we look to the right, retail sales in the lighter blue have been pretty resilient, but have been volatile as of late, and we'll get into that a little bit more later, and trended downwards, mostly due to the recent increase in oil prices. And if we look at consumer confidence in the dark blue, that continues to wane, being below where we would like to see it as lending conditions continue to tighten. And if we look at personal savings rates and consumer spending, you can see the rate in the orange or yellow, whatever color you see that as. On the left, we see it's been supported by a dramatic decline in the savings rates from pandemic levels, and supported by a subsequent increase in revolving credit card debt that you can see in blue in the chart on the left, as it reaches close to 12.5% of discretionary spending last month. As we look to the graph on the right, spending on services in the lighter blue has offset relatively softer goods spending, as you can see in the darker blue on the bottom there. And if we look at consumer savings and borrowing, so this is an opposite way of looking at consumers in terms of spending. We see that the average is 8.6% of disposable income, and year to date we're below that at an average of 4.2%. Not too surprising, considering consumers saved $2.1 trillion during the pandemic relative to pre-pandemic trends, and have drawn down that savings with $200 billion still remaining. But as you can see on the bottom right-hand chart, revolving consumer credit outstanding is continuing to etch a bit higher, ending July at 6.3%. Certainly, savings are being spent back to pre-pandemic levels, as you can see in all of these charts, highlighting, the sentiment that our economy is still made up 75% of consumer spending here. And if we look at inflation, we can see that the service sector, continuing the theme of last quarter, is still driving the bulk of inflation. And it was obviously a theme of last quarter too. All the different sectors that made up CPI are in different colors on the left, showing over a time period between 2017 through up to this year. And we can see that goods-oriented inflation is well off its peak, while services prices are starting to moderate, but for the most part remain stubbornly sticky. Trends and leading indicators like money supply growth and contractions that you can see in the chart in the right in dark blue, while recessions are indicated in red, still are favorable, and continued easing in price growth given how quickly the money supply has dropped since its dramatic increase in 2020. Pace of inflation still remains unclear, as certainly as a continued theme from last quarter as well. And if we look at inflation components, just a different way of looking at inflation. On the left, you can see the top contributors to headline inflation, which includes all categories, with shelter, restaurants, hotels, transportation, remains the stickiest through August of this year, ending overall at 3.7%. If we look at the graph on the right, it shows us core inflation, which excludes, typically more volatile items like food and energy, but transportation continues to be sticky, especially with oil prices on the rise last quarter, while airline fares, medical services are seeing a decline. Overall inflation still coming in higher than the Fed's target of 2 to 2.5%, but it's down significantly from last year. But and headline inflation being over 8% last year, and core inflation reaching over 5.7%. And this is the inflation heat map. It's certainly been interesting to see how this has changed over the past 3 quarters here. This shows us where inflation continues to be sticky versus, where it's coming down. And it's interesting to see how it's changed over that time period. We can see that over the past 2 years, inflation picked up in almost every sector, but the map is continuing to get greener, meaning inflation is becoming less sticky over the past quarter as it's cooling off in almost every sector, but gas, electricity, transportation services in August there. Headline inflation, including food and energy, finished the month of August at 3.7, down from last quarter, while core inflation excluding energy and food came in a bit higher at 4.4%, still down from the last time we saw this back in May, as you can tell on the graph there. And you can see the biggest shifts in food and core goods as compared to 1 year ago. Hopefully everyone's wallets are still continuing to feel better at the grocery store, but inflation has remained sticky in core services sector, but certainly getting better, given the fact that we know services are still driving a bulk of the inflationary pressures. And if we look at this from a global perspective, we can see that global inflation may be in the process of rolling over, although the disinflationary process is likely to be choppy, especially as some countries continue to face tight labor markets and potential threats from rising energy prices. And one last look at inflation here. This chart shows a look at the average CPI over the past 50 years, with headline being at 3.9%. In August, we ended at 3.7%, being right around that average number, while core remains about 0.5 percentage above the average, with a similar story on food, but we see a contraction in energy. Regardless, I think this slide does a really good job of illustrating inflation coming off peak levels that were reached over the past 2 years here. And if we take a look at check-in on housing, we can see that the housing affordability has tumbled due to stubbornly high and stickier home prices, even as the spike in mortgage rates with inventories still at record lows. I think it's worth watching the recent decline in some lending housing indicators, like a drop in existing single-family homes, declining conditions for buying, and declining mortgage application rates. If we continue to see this kind of slump being sustained, it may lend a less to support a broad-based economic soft landing, as housing makes up about 4% of GDP there. And if we continue to look at this on another level here, this is just a different way of looking at houses. We can see that monthly mortgage payments, have doubled since 2021. Not surprising, given that rates are around 8%. But also fewer people are listing their homes for sale at the moment. Also not too surprising, given that 98% of mortgages are below, have been refinanced in the past 2 years here. And fewer bidding wars, as we can see recently, because of higher mortgage rates and higher mortgages rates not weighing on home price inflation yet. And the next slide here, we will. So just to wrap this up here, as we look at, a number of different variables that provide really valuable insights into the state of the economy and help the Federal Reserve shape their policy decisions. We see that last quarter had some bright spots, including industrial production and a tight labor market, where retail sales is slowing down is really the only indicator that was down less than 1%, as you can see on the bottom there. Still lending, the possibility for recession and neutral territory, and the idea of that soft landing coming more into fruition here.
That's great. Thanks, Maddie. Appreciate it. Great update. Again, I think this kind of gets back to one of the titles of the presentation today. Like, good news may not actually be bad news, though sometimes the markets seem to get mistaken. Just want to hit on banks, assets, liabilities, right? We're in the midst of earnings season. We've really heard from a lot of the banks, Goldman Sachs, Bank of America today. We heard from JP Morgan, Wells Fargo, and Citigroup last week, and I think we heard from Morgan Stanley tomorrow. But, I think the banks are, safe to assume have been kind of like the maligned and hated sector this year. The regional banks in particular have had a really tough go of it. I think there's a perception out there that there's a tremendous amount of risk, both on their balance sheet, specifically on long dated paper, right? They bought mortgage-backed securities or treasuries when they thought rates would stay low forever. And then on top of that, again, perhaps some losses to be sensitive to with respect to, commercial real estate, in particular office space, maybe to a lesser extent retail, because that's been a conversation that's going on for a while. You can see large banks, it's a pretty manageable risk, right? Like, again, by and large, commercial real estate's a pretty small amount. That's partially because it's a regional story, right? When you're underwriting a loan for a strip mall in, Kansas, it's probably safe to assume that JP Morgan's going to have less intel than, United Missouri Bank, right? So in the scheme of things, we're seeing that commercial real estate exposure is on the part of really the smaller banks, and so that's why they've lagged a bit. In addition, the perception of safety or flight to quality has seen assets kind of shift out of those smaller banks into larger banks, even despite the fact that rates aren't all that great. If you look, it's interesting. I apologize, it's a bit of an eye chart, but the 3-month Treasury bill is 540 as of the end of September, but 6-month CD is still only 2.2. So banks are still very much reluctant to part ways with those higher rates, and it's even worse when you look at savings accounts and checking accounts. So again, banks are important, right? They account for about 13% of the S&P. Again, I think that we're kind of in a trough environment where, for all intents and purposes, sentiment's about as low as I've seen it since going back to GFC. So again, I think that the risks are manageable. At the same time, I wanted to make sure we address them. Hop into the dollar, right? Again, we've spoken a little about that. The dollar had a massive run in 2022. You can see, really, dollar peaked at 112 last September, largely in the back of a very aggressive monetary policy. As Europe and the UK and others kind of caught up a bit, early part of this year, you saw the dollar weekend, which had a positive impact on U.S. multinationals as they translate sales back to dollars. Again, that reversed a bit in the third quarter, a combination of kind of a slowing economic data out of Europe, the better economic data in the U.S. It meant that perhaps again the dollar's the place to be for a little bit longer, at least until they start cutting rates. So that has a little bit of a near-term impact on corporate earnings. Again, it's probably, and this is spin, impacted positively the level of inflation. And again, if you're traveling abroad, but nonetheless, again, I don't want to make that sound like that's something to be excited about. Trade balance, again, you can see that we've been in a position where we run a pretty massive deficits. We continue to run deficits, but they've come off a little bit. And so that's just, this concept of onshoring. So it's just, again, that we're not buying as much as we have durable goods. Durable goods are largely imported. So in the scheme of things, again, trade balance is likely to be in my lifetime, and I'm 44, so God willing, it's another 50 years. I don't see us having a positive trade surplus anytime soon, maybe at the margin in some sectors or industries. And then developed market interest rates, right? Like what, again, pulls people into the dollar by and large is the fact that you're getting a comparatively high yield here. You've got some stability with the currency. I can't say that the political environment's very good, but nonetheless, the dollar ultimately is an important component in kind of determining where asset prices are likely to be over the short term. So we'll transition to U.S. equities, right? Again, when we folded in commodities, we'll spend a couple minutes on commodity slides simply because people had asked for that. So here is a good view of the S&P, right? If you go back to the peak of the market, which is January 5th of 2022, the S&P traded around 4,800. Forward multiple of 21 times. So pretty expensive by historic standards. The long run average, is closer to about 16 or 17. Today with the bloom coming off the rose a bit, both the sell off last year and then, kind of a choppy market this year, earnings have been flat to down, right? So we haven't had much lift on the E side. That might improve, which we'll talk about in a little bit, but, at the forward multiple of 18 times, less expensive market, but still not exactly cheap. And then you'd argue that when you compare stocks versus alternatives, specifically treasuries, we're now, they're yielding 4.8 as I talked to you today, the 10-year, that's pretty significant versus where it's been. You have to go back to 2000 when stocks were, massively overpriced and fixed income provided a pretty compelling return. So again, just got to be sensitive to valuations and future expectations. We'll hop to the next slide. So this is a breakdown of the U.S., right? Like as well as the overseas market. So you can see the Dow, kind of the old economy stocks, held up fairly well, right? Again, there's a little more Exxon, a little more Chevron in there, so down 2%, whereas the S&P was down about 3. You can look in overseas markets, kind of mixed picture, right? The more commodity centric, markets, Canada and Latin America have held up a little bit better versus Europe, which is a little bit softer. Japan continues to be like an interesting story, right? The Japan market has been on a tear, right? Third quarter gave back a little bit, but if you look at it from a year-to-date perspective, only the Nasdaq is ahead of Japan, and that's largely on the back of what I would describe as pro-growth initiatives. They haven't seen inflation for the better part of 3 decades, and so they're happy to let inflation run around 2 to 3%, which seems, again, to us a wonderful number. You can see again on the basis of valuations, right? U.S. stocks represent a fairly expensive proposition versus the developed market, as well as versus the emerging markets. Again, there's a reason for the discounts. We get that, but at the same time, usually they're not quite that wide. We'll talk about that in another minute. To get down into the U.S. in a little more depth, right? We'll look at sectors and styles, and so on a year-to-date basis, you can still see it's tech and communication services and consumer discretionary, where Amazon hides out, all in that 30% territory. Although the bloom came off the rose there again, down 5.6% for inflation and for information technology in the third quarter, and a lackluster return for consumer discretionary. The biggest impact, which was somewhat surprising, honestly, was utilities, right? Down almost 10%, and that's very rare. Some of it probably was a little attributed to some of the risk that we see from a natural disaster perspective. We obviously a tragedy in Hawaii, but historically, utility stocks have some inflation pricing power. They can go to their regulators and increase rates, but they are also considered bond proxies. So when rates move as much as they do, that's why I saw some downward pressure on utilities. Consumer staples also had a tough quarter, right? If you believe a recession is in the cards, right, the market's probably going to own more consumer staples and more utilities. So maybe that's a leading indicator that the golden path, or the new name for the soft landing, is perhaps a bit more likely. Energy was obviously the standout, nearly 12.5% return. Again, took it from deep in the black, deep in the red, excuse me, to the positive for the year. And you can see in the fourth column over, year-to-date returns, healthcare, financials, consumer staples, utilities, and real estate. So half of the market is basically down through the end of the third quarter. We'll hop to the next slide. This is a piece, and again, you'll see some in a minute, but like we harp on this, and to be very clear, we're not opposed to owning big cap technology stocks. We most definitely own them. We just want to be sensitive to how over owned they are in the market as a whole, right? The most recent data was that the Magnificent Seven accounts for 30% of the S&P, right? Here you're talking about the top 5 stocks, about 25%. And you can see they've driven the performance, right? Go back to the pandemic, rocketed out of the recovery in March of 2020. Obviously hit a pretty big air pocket back in 2022 as the Nasdaq sold off 30%, but you can see they've almost recovered where they were back in that peak of November 2021, January 2022. Aside from those call it big mega cap stocks, right? If you take the S&P less those top 5, it's been pretty pedestrian since the pandemic, right? I mean, again, you go back and say, hey, all things be equal, if it's January 1st of 2020, and I said to you to have a cumulative return of 25%, you might not be all that disappointed. But when you're watching your buddy who owns Tesla and Nvidia just run away from you, it can be a little frustrating. So again, we want to just highlight concentration. This is a cool piece to me. Again, it's really the kind of heat map, right? And shows you how a handful of stocks just stand out relative to how much they have influence on the market. So even big companies that we've been around, that have been around for a long time, are pretty small by comparison, right? If you look at like a Caterpillar, it's in the middle, kind of small. Apple, Microsoft, Google, Amazon, kind of eating up the whole page here. So this was a point in time, 3-month look back, shows again kind of captured the last 3 months for these respective companies. You can see again energy, which is that far right hand box, a lot of green on the screen. So again, just be sensitive to how concentrated your portfolio is. Even if you have diversified investments, which we espouse, the fact is you got to make sure that diversification is really at the holding level, not just at the position, at the overall security level. We'll hop to the next slide. This is in my mind pretty interesting, right? Like, again, I look at mean regression, mean reversion, right, as somewhat of a guide for future asset class returns. We'll talk about that in a minute. Schwab does a nice piece there. But the forward PE on the S&P based on a 17.8 multiple is it basically says that, equity returns by and large are probably going to be in that 5 or 6% territory, right? And that's on a kind of rolling 12-month basis. If you look at, the next 5 years, the annualized return is probably, again, in that 5 territory. Cumulative returns about 31%, right? Like, so in the scheme of things, not exactly something that you're going to go ahead and buy the beach house on, but still a positive number. I just think the expectations have to be mindful that they portend lower returns over the short and intermediate timeframes. These are some technicals, right? Like, so, there's valuation, which we care about. Again, because of the S&P is so dictated by a lot of these companies, I would say there's other ways to look at the market, right? And this isn't to, hey, run out and sell your stocks. That's not what the slide's designed to say. It's just saying, hey, be sensitive to the fact that, compounding returns in that 13% territory year over year is harder to imagine given how expensive things are. If you look at the technology, or you look at an equal weight market, but equal weight market trades closer to 14 or 15 times, similar to the long run average. So that might be an opportunity again to just spread some of your risk around a little bit more thoughtfully. So again, just a lot of technical indicators suggest large cap growth stocks in particular are expensive, and this is a great value versus growth comparison, right? When you see on the left hand side the long term averages, growth stocks should basically trade a little bit of a premium, right? Because they're growing faster. But at the same time, there's a justification as to how much you're willing to pay for that premium growth. And now we're seeing again, sorry, Siri seems to like my voice. The valuation differential based on value to growth suggests that value stocks are poised for better returns over the next few years. Again, we can't tell you when that's going to start, but it's safe to assume that they're starting from a much better launching point. You can see dividend yields are about 2x what they are in growth, and then on the basis of the PE ratio, let's call it 13.7, which is below the long run average of 14 versus the growth, closer to 24, 25 versus 21. And you can see, specifically on the right-hand side, which sectors and styles are more in the value space versus growth. And again, it's not as, we don't believe in being dogmatically sector driven around value versus growth. We're much more nuanced, right? You can have growth companies in industrial or financial sectors. You can have value stocks in technology and healthcare, right? Like, it's important to just, be somewhat mindful of that. But energy, materials, financials, all are trading with fairly attractive valuation and operating leverage, which means incremental additional dollar that rolls downhill will have a much more positive impact on earnings, right? Think about that mainly in the context of technology companies are very asset light, right? Whereas in an environment where you've got heavy machinery or more kind of old economy stocks, that incremental additional dollar revenue will have a bigger impact on earnings. So let's hop to earnings, right? So here we are, right? Again, early innings, very, very good story. Again, I'm not going to count my chickens. It's kind of like the Texas Rangers up 2-0. I'm not ready to write off the Astros, although I'd like them to lose. So we would say to you, let's see how the rest of this shakes out. Next week, we'll start to hear from the technology companies. They're likely to actually show some positive growth after, the comps were a bit more challenging in the, first and second quarter. Earnings growth for three successive quarters was negative, right? I know that's a misnomer, earnings growth and negative, right? You should just say earnings decline. But we expect earnings to grow here in the third quarter, likely in the 3 to 4% territory, before accelerating or growing a bit more significantly into 2024, likely in the high single digit, low double digit territory. And if that plays out, you can make the case that stocks can go higher as the multiple kind of gets pushed up by higher earnings. If we don't see earnings growth and you see a little bit of continued margin pressure, stocks probably don't have a lot of upside here, right? And again, that's at the sector level. Look at margins. Actually, go back, Maddie, for just one sec, if you can. Margins, again, are pretty fat, right? You were looking at, 9% margins, right? Like, and, by and large, revenue growth is slow. So there's only so much blood you can squeeze out of the rock, right? So hopefully, that continues to be somewhat healthy, the margin story, but it's safe to assume that's probably going to come down from, where it is today. The small cap, large cap story. We'll actually have a cool slide at the end, which is really eye opening. But again, back to the idea of small cap stocks, which have been really kind of hammered the last year and a half, 2 years. The perception is like they don't have the best balance sheets. They're a little more tied to the economy. They're a bit more interest rate sensitive, and so you can see large cap stocks today are by and large pretty inexpensive, right? Like, if you look at the lower right hand quadrant, you can see that they trade pretty close to their long-term average, whereas growth stocks are traded by roughly a 30% premium, or large cap stocks trade for about roughly a 30% premium. one thing you got to be sensitive to in the small cap universe, right? A lot of the Russell 2000 is just unprofitable companies. They're biotech companies, they're technology companies, they're early innings in the development, and they may not materialize. So we tend to have a view that you want to own profitable small cap stocks, and that sounds like obviously a logical thing to say, but there can be a value owning more cyclical or distressed small cap stocks, but you have to be convinced that the economy is about to turn higher versus this kind of like grind along that we've been in. You can see again on the left hand side, like technology is a very small part of small cap stocks. Industrials and financials represent the biggest piece, and you can understand why. Again, that's more of a value play itself. This is just a quick hit on kind of returns at the asset level. We're not going to go through this in much detail, but you can see again growth had a pretty good year to date number. It's pretty good since the lows of the pandemic, March of 2020. But now again, they're pretty fully priced, right? Lower right hand quadrant will show you that. Excuse me. This is what I was alluding to before. So Schwab does this report, which is kind of neat. Look at future asset class returns based on looking at history, right? So you go back the last, let's call it 50 years. U.S. stocks average about 10.5%. Again, not dissimilar from the 1926 to 2022 period, right? Small cap stocks also a similar number, but forward returns are projected to be somewhere between 35 to 40% less than that, right? U.S. stocks have had a leadership position for the last call it 2 decades, right? International stocks less or so. They're more likely to provide inline returns based on historic averages. Whereas fixed income, again, like this slide might be misleading because it says, well, bonds are still providing less historical return. But if you look at that by comparison to where you were mainly, 2, 3, 4, 5, 6, you can go back forever, to the late 2000, like 99, 2000 territory before, fixed income was anywhere near that, 5% territory consistently. We saw a little bit of a bounce in 2008. And cash, again, not a bad place to be. Commodities, right? So we figured they're important to spend a little bit of time on, right? We can see commodity exposure in stocks, right? The S&P and Dow have energy companies in there, as well as material companies and agriculture companies. But like to just peel back the layers of the onion, looking at energy, metals and agriculture individually, like see energy up collectively about 30% over the last 3 months. If you look at the top left-hand side, gasoline was down a little bit. Again, that's idiosyncratic, has to do with refiners, but by and large, again, 30% move in energy prices. Metals were pretty flat, right? You can see gold, down, silver down. Why was that? Again, interest rates continue to be high, and so there's an opportunity cost. If you own an ounce of gold, 10 years from now, what do you got? You got an ounce of gold. If you get 4 or 5% in a dividend or an interest payment, that seems a little more compelling. Agriculture, again, not seeing this at the grocery store, right? Like, corn, wheat, soybean futures all, kind of rolled off quite a bit, almost down 20, 30%. That will take a little bit of time, just like as we're seeing today, gasoline prices are feeding into the economy. We're seeing gas prices drop almost 30 cents in the last, 4 weeks or so, and that's likely to continue. So on the commodity side, again, just a noisy picture. I think directionally is still a positive, but nonetheless, again, really volatile. And then, last piece I want to just, highlight on energy real quick. You look at where the U.S. is from a production perspective, right? We basically have grown production over the course of the last 5 years by about 10%. OPEC and Russia have seen their production drop, right? So we're very comfortable being more energy independent. We still import, some portion of petroleum products, but we're net exporter, right? You can see consumption for us for the last 5 years is down. Some of that's just more sensitive on the consumption side, some of it's the greening of the grid. But again, India and China continue to consume quite a bit. So demand's not going away. It just might slow a little bit from where it was in prior years. And then inventory, it's been a big talking point, right? At one point in Oklahoma, they talked about the Cushing fields basically, running pretty close to dry, not literally, but below levels that are normally the case. And so that creates some short-term volatility in there. But let me turn over to Tom to kind of take us home on oil as he transitions to a conversation on emerging markets and international equities.
Perfect. Thanks, Jeff. Appreciate all that you shared. And thank you, Manny, for flipping back to that slide just quickly. If you look at the relative peak on March 8th, 2022, that really was a spike that we saw in response to the Ukraine war. Obviously tragedies going on all across the world, Ukraine being one of them, Israel being another right now. And I'm sure we'll talk about that more and more next quarter. But as you look at March 8th, 2022, that was just a spike in per barrel nominal prices. At that time, in response to it, to try and bring that down, the Biden administration actually released a large portion of the strategic petroleum reserves. I wrote that down. I think it's a tongue twister, so I just want to make sure I got it right. But so we released that, prices come down, and now you start to see, as of September 30th, prices are starting to creep back up. We haven't yet actually built back our reserves. So right now we're actually at a point where I think we're at our lowest point since 1980 as far as what we have in reserve. And so that is something that is on the horizon and could influence oil prices going forward. So just one thing to keep in mind. That's where we are right now, but that might be something that it's either going to stay at that level or it could creep up over time, depending on how we do decide to build back our strategic reserves. So I just wanted to add that one piece as we transition over to the international markets. So Jeff actually covered this slide, I think, really well. If you look at just that second column in the 3-month, there are a lot of negative numbers there, even though the year to date, the 1 year, the 3 year, there are a lot of positive numbers, which is fantastic. I'm not going to spend a lot of time on this because Jeff did such a good job, but wanted to give you one more peek at it, just if you were curious about domestic markets as well as international. So next slide. Thanks, Maddie. So really, I love this slide. This is something that you'll probably see quarterly market update after quarterly market update. Really why global diversification makes sense. If you look at this, there's no discernible pattern, with large cap, small cap, high yield bonds, tips, really all over the place, right? The colors are moving. If you look at the white, kind of in the middle is a diversified portfolio with white with blue writing. And you kind of see that snaking along the middle section. It's typically not going to be a top performer because it owns some of the bottom performers. It's not going to be a bottom performer because it owns a lot of the top performers. We believe in diversification. Most asset allocators really do. That's the bread and butter. And it really is a great idea to participate in really all different sectors of the market. So that's it for that. Next slide. Thanks, Maddie. This is just cycles of US equity versus international equity. So US equities, kind of that charcoal color, internationals purple. And you can see all the way to the right, there is actually seemingly a period of time, right, where the international markets have outperformed domestic markets a little bit. We don't know yet if that will be the trend, and that'll go on for a number of years, but based on some of the slides I'm going to share, there's a good indicator that that could be the case. There could be some outperformance in the international markets, and it's important to just have that as a component of your portfolio. Next slide, please, Maddie. Thank you. So this is PE ratios. If you look in blue, it's the EFA, the emerging market, and versus the S&P, which is in the darker blue there. So PE ratios down right now, 18 for the S&P 500, the EFA at 12.9, the emerging market at 11.6. And if you look at those numbers, the S&P 500 over its 15-year average at 16.1, the EFA is below the 15 average, 12.9 versus 13.7, and emerging markets are pretty much right at the 15-year average. 11.6 compared to 11.4. So relatively speaking, international markets are a little undervalued compared to the domestic markets. Next slide, please. Thank you, Maddie. So this is just a breakdown of lots of different countries, just to kind of give you a sense of where does the US fall from a valuation standpoint compared to, if you look, the Netherlands, Portugal, Ireland, all above the United States. And then pretty much every other country that we track is down below. So there's a lot of opportunity internationally to invest. As you look at individual countries, there are reasons, for the valuation on that particular country. I'm going to highlight a couple of them on the next couple of slides, but as you look at it, as I said, lots of opportunity to invest, to diversify, and hopefully capture upside as these countries produce like all the local goods, local product, all the things they're exporting, hopefully is going to continue to just push the global economy higher. Next slide, please. So China, one of those countries, they were to the further right of that slide, meaning they were showing as undervalued. there's a lot going on in China, as I feel like there always is. It's a gigantic country. It's a monster economy. It's something that's going to influence, our economy, the global economy over the course of time. Exports, in light blue there on the left-hand side of the chart, you can see have actually been down quarter over quarter for the past few quarters. China exports a lot of their goods. Their economy is really not a consumption type of an economy, even though the line above net exports, you see that consumption has ticked up some. Part of that is just governmental control, not necessarily wanting to shift to a consumption type of an economy. And even as you look at investments, like their economy started off really well following, COVID, but it sputtered pretty quickly, and that is a big concern. Up in the right-hand section there, household deposits versus household loans. This is an interesting one. Usually, like, you look at that and you're saying, oh, great, the consumers is getting stronger. They have the ability to again, consume more, buy more, participate in the economy a lot more. What's interesting, actually, shifting down to the bottom section there on the right-hand side, is a lot of savings by the average Chinese citizen is actually in real estate. So they buy a lot of real estate, and there have been a lot of problems there too. So Evergrande was a name that I think we all became familiar with, maybe 6 to 12 months ago, as they were defaulting on loan payments. And now Country Garden is the next big real estate company that's having some trouble in China. And there are also there's kind of the main banking system, then a little bit of a shadow banking system in China. Some of those companies are having issues as well, meeting their debt obligations. So China's just, to me, an economy to watch. Again, they have such a massive influence on the global economy that we need to keep our eye on that. It's as I said, it's a complex situation, but there's some kind of harbingers of trouble here. So we'll see kind of what direction China goes next. A lot of their influence seems to be getting away. Like, they're not jumping in and diving in with spending and dumping a bunch of money into the system to prop up the economy. They're letting this play out a little bit, which seems to indicate that their global influence might be a little less economic going forward and a lot more political. If you look at a lot of the things that they've done as far as trying to broker peace in the Middle East in a few different areas. So something to watch, something to pay attention to. Shifting gears over to India, it's a very different story. India has actually been growing by leaps and bounds as it relates to not only just their working or working age population, but also their middle class has grown very significantly. You can see the Indian government is spending money, so they're trying to really spur the economy on. A lot of international companies are investing in India because of the workforce that's available, because of the high level of education that's in India. And if you look down that lower right-hand section, corporate taxes are just pretty competitive worldwide. I feel like if India were to ever drop their corporate tax, then they would have even more investment. But they're at the same level as China, and I think in some cases have provided a nice alternative for companies, like I said, that are looking for young, educated workforce to really be that workshop of the world. So I just wanted to highlight those two. Just I think they're important, obviously, players on the global stage. So next slide, please. One last case for international exposure. If you just look at the correlation between stocks, like it's on the lower end right now, meaning not everything's moving in the same direction at the same time, which is what we want out of our portfolios, which is why we, do diversify, as we're looking for lower correlation. We're looking for the ability to just be better and better diversified over time. So that's it for that slide. On to fixed income. If we take a look at, fixed income returns, a similar slide to the global markets on the equity side, over the last 3 months, the left-hand column there, we're still in negative territory. Bonds, generally speaking, are going to be a lower volatility type investment, even though 2022, that was not the case. 2023, they're hanging in there much, much better. A lot of these negative numbers are as a result of yields being really low and interest rates being raised over time. Now that yields are a little bit higher, if we see any additional interest rate rises, that should buffer bonds a little bit better and hopefully keep us in positive territory. You know, and ultimately, I think we'll see how the Fed attacks rates and how they change rates over time. But that explains just kind of why we're a little bit negative, and the expectation is hopefully going forward will be a little bit more positive, even if we see some increases in interest rates. Next slide, please, Maddie. Jeff had mentioned, you know, high yield bonds, yes, being something that, you know, there's been some positivity still in that, which has been a bit of a surprise. Usually as we see higher yields, that comes with higher risks, right? So if we start chasing yield, whether it be corporate high yield bonds, master limited partnerships, preferreds, REITs, you know, there are a number of things on the fixed income side of the ledger where, you know, we may have positions there and we may be looking for additional yield or diversification. But the idea is that we need to moderate risk, right? So bonds usually are not, as kind of the old adage goes, like they're not there to make you wealthy, they're there to keep you wealthy, you know. So we're paying attention to risk and return on the fixed income side of the ledger as well as the equity side. And it's important to know that, you know, even though these are showing the, you know, worst 12-month rolling periods, there's risk in some of these investment classes, and a lot more than some people have, I guess, maybe experienced the last 20 years or so. So it is something that, again, we're focused on, we're paying attention to, and we're allocating assets accordingly. So next slide, please, Maddie. Thank you. Just as far as the Fed, you know, what's the plan for the Fed? And really, the Fed is still signaling that, you know, there's a possibility for another rate hike or two. The market is really looking at it and expecting that it's more like 1 versus 2, but we'll see. You know, it's an ongoing conversation and ongoing situation where things are changing, things are going up, things are going down, things are influencing the Fed's decision. You know, interesting to see how it's going to play out, the impact on that 10-year Treasury yield. I think, you know, it's been up and up and up, which has been generally a good thing. Again, to get a little bit more yield on your fixed income has only added to, you know, total portfolio return. Next slide, Maddie, please. This just a sharp rise in real rates and nominal rates. Again, it's been a good thing. You know, we've been able to capture a little bit more yield. That said, because inflation has gone up, you know, wall rates have been going up. We want to make sure that we're maximizing that opportunity. So, you know, we're going to be thinking about the length of, you know, average maturity. How long are we going to go out as far as bonds go? How do we capture and make sure that we're getting the best, I guess, the best return that we possibly can, but again, without, you know, taking ourselves and overextending ourselves from an average maturity standpoint. Overall, it is a positive story that we've been able to pick up that additional yield for sure in the short term. And you know, and again, we're looking to make sure that we're capitalizing on it beyond, you know, even just this year, next year. Hopefully, we'll be able to capture it beyond. So, thanks, Maddie. Next slide. Rate hike cycle. This I thought was a really interesting slide. Intermediate term bonds have outperformed short-term bonds really over the last 5 cycles for the 6 months after rates have stopped going up, which again could influence, you know, how we look at bonds, how we look at duration, how we manage average maturity within portfolios. And I just really like the statistic. It's an interesting one, and I think again it will have real world impact on portfolios. Next slide, Maddie. Thanks. So interest rates, 1/2 of it. The Fed is also doing quantitative tightening. They're going to continue to reduce the size of their balance sheet for the foreseeable future. So even if we do see interest rates stop going up, there could also be that influence, or will be that influence of them reducing their balance sheet over time and tightening that money supply. So next slide. Thanks. And yield curve, you know, we've talked about this in the past, and I've got one more slide on this, where, you know, when short-term rates are higher than long-term rates, so the yield curve gets inverted, it has been an indicator that recession could come. That said, recessions historically, you know, they don't last forever. They're 6 months to 18 months on the long end. Average is about 11 months. So if it does happen, we'll get through it, but often, again, you see that inversion before a recession potentially comes. It's not a one-to-one. It doesn't happen every single time, but we're definitely in an inverted yield curve environment right now. This is just a good illustration of that. I won't beat it at horse, but where you see it's higher on the left side, lower on the right side, that's an inverted yield curve. And so where we see kind of the progression over time, December 31st, 2021 on the bottom, December 31st, 2022, there in the middle, and in September 23, we actually have seen, if you look at that, even the longer end, the 20 and 30 years have actually started to drift upwards, which is a good thing, to get a little bit more yield on the longer end. Thanks. That's it there, Maddie. Thank you.
Now to finish out the section, hopefully everyone's still awake here. This is our last one. We have less than 10 slides to go. Asset allocation, everyone's favorite topic, drives over 90% of your overall returns. So certainly something that we really pay attention here. So if we look at a longer term view of US inflation, if we zoom out and take the bird's eye view, we can see what's been happening in previous surges of inflation that were associated with some unique historical events, some of which lasted for years. More active, monetary policies have been in place since the early 1980s. And we're starting to see some signs that the ultra aggressive Fed actions taken within the past 2 years may be able to contain core inflation in the near term. Historically, as you can see from the box on the bottom, we've seen that higher inflation being correlated with weaker stock markets and economic gains. But COVID inflation surge is still below some of the larger historical levels from events like World War I, post World War II, and certainly the inflation of the 80s there. And so if we look at that, what does that mean in terms of our investment goals? So if we look at this over a 97-year period, and we look at all of these different asset classes from small stocks, large stocks, government bonds, treasury bills, and inflation, we can see that through all of these major historical events, a lot of which were newsworthy, like Pearl Harbor, the Gulf War in '86, the Great Recession, so on and so forth, we can still see here that if we invested $1 in the beginning of that time period, 1926 to 2022, you can see how that dollar would have correlated with each different asset class and its compounding annual returns there. So we can see that small stocks, or this darker blue, would have turned into 50,000, large stocks, 11,000, so on and so forth. So certainly, still a good place to be in terms of investing and making sure that your portfolio is diversified. And if we look at that, continuing that diversification theme, this slide here really highlights the need for diversification and how it can make that roller coaster of investing smoother. So this slide really shows the range of outcomes between stocks, bonds, and bond returns, along with the range of how a diversified 50% stock, 50% bond portfolio performed between 1950 and 2022. Stocks had an average return of 11.1%, bonds average return of 5.5%, the diversified portfolio of 8.7%. Along with that, meant for the growth of $100,000, we can see how that translates over that time frame. And what I think is important here is the 50-50 portfolio captured 64% of the upside of what the all stock portfolio would have done in that same time frame, only taking on 50% of the risk. So we can see that, continuing to have a diversified portfolio construction conversations with clients is really important, and certainly continues to be one of our guiding principles.
All right, I'm going to jump in here just quickly on this slide. I love this slide. Annual returns and intra-year declines. So if you pick a year there, you can see the red dot is the intra-year decline, and then the gray bar on top of that, often positive. If you look at the top, it's 32 out of 43 years are positive since 1980. So vast majority of the time the market goes up. but there's volatility in any given year, which gives us opportunity to rebalance, to harvest losses on the tax side, or taxable side, I should say. And ultimately, the markets never stand still. So I love this slide again because, whether the market's going up and we're having a great year, we can see that intra-year pullback, and we have the ability to make changes and take advantage of it. Next slide, please, Maddie. Politics versus sound investment principles. So this has crept in a few of the conversations I've had recently with clients where people are kind of curious and starting to think about 2024 a little bit. And, ultimately, as you look at whether it's blue, whether it's red, and kind of regardless of what's going on, whether it be, you can see 2008, right at the end of George Bush W. and beginning of Obama's administration, there are periods of time, there are things that are going on, there are things that are going to influence the market, but we've lived in a time and some before our time where the market has continued to really trend up and to the right, which is a fantastic thing. And again, not to be partisan at all, like either way, whether it be blue, whether it be red, it's been a really positive trend, and that's a good thing for all of our investment accounts.
So I'll take us home. Thanks, Tom. Appreciate it. With respect to bull bear markets, right? So again, the nice news is the blue lines or the blue rectangles seem to be a bit longer, and the pink lines again generally a little bit shallower, or frankly a little bit shorter. It's still in by some definition a bear market. Some people will say we start a new bull market in June of this year, but the fact is, again, we still have a little ways to go to recover from the all-time highs we saw back in January of 2005. But just comes back to, again, looking to see the forest for the trees, where lines up and to the right, and again, no one wants to go ahead and sit through a 14-month bear market. They'd rather have the 70-month bull market on average, and the returns that go along with that. But we know as investors, like, it's just it's par for the course, right? So again, we don't want to make this sound like we're overly pessimistic or cautious in the short term. We're just a realist, right? Like, one thing that we have to be very sensitive to, like, we've got student loan repayments beginning here earlier this month. We've got a humanitarian crisis in the Middle East. We've got a lot of different things that can impact sentiment and consumer behavior. But in the long run, like that slope up to the right. And I'll have you up to the next slide. It's kind of a cool piece, at least in my mind, right? Like, this is looking at the same 96 years or 97 years that Matt had before, and markets only 7 times in that 96-year period of time had declines of 12% or more, right? So 74% of the time the market had a return, positive, absolute. But the biggest one, right, like the most significant relative to the statistical probability is a gain of 12% or more, right? Like, so you have to stay invested. That's the point, right? Like, no one is smart enough to go ahead and sidestep the market. You're just lucky. It's just a fact, right? Like, some of the brilliant people of the great financial crisis, Bill Ackman, Daniel Loeb, I could go on and on and on, and they've been lagging the market for the better part of 15 years. So as much as they would like to take credit for oppression call, it was frankly just dumb luck, right? So again, just keep in mind that you're rewarded for taking that long-term risk. So we'll take us home here, Maddie, on the last page here, right? Like, so the Fed might be done, right? I think that's the sense I have, right? But done is not necessarily like, hey, we're reversing course, right? Like, they very well might say, hey, we're not going to raise rates again. We might even cut rates in 2024 at some point, especially if inflation continues to bend down. But they're still going to shrink their balance sheet. You've got $9 trillion. Well, now it's about $8 trillion. That's kind of a byproduct of QE through the last 15 years, and it really ramped up a lot in the pandemic days. So I think that monetary policy is going to likely be a headwind, at least for the foreseeable future. The soft landing is in fact increasing in terms of its likelihood, but again, I think we've got to be comfortable that the recession risk will continue to dissipate, and we probably need some contribution from overseas. Where Europe has been kind of on its back. And we talked a little about China before, and China, doesn't believe in direct consumer stimulus, right? They really kind of go ahead and feed that through, the corporate engines, right? But if we get some, lift from the overseas markets, that'll be a positive. Unemployment's going to be a big driver, right? Like, we hear the story with respect to the UAW strikes. Again, I'm not sure that, their negotiating time or the negotiating, process is as well thought out as they might like. And I think that demand has obviously come off quite a bit from where autos were last year. But, again, you couldn't possibly pull this off in a recessionary environment. But again, I still think that the most important data point to look at on a weekly basis is at 8:30 on Thursday, which is the new unemployment filings. Again, earnings. Let's keep our eyes to the monitor, right? Not literally. I want you guys to enjoy yourselves. That's what we're doing. But if earnings grow, right, stocks are supportive of higher prices now and in the future. And value small caps overseas look like they have more relative value. Again, I think that on the equity side, I wouldn't be surprised if we saw a rally in the fourth quarter. Maybe it's already underway, but at the same time, again, it's probably likely to be not necessarily the same people that carried us for the first 9 months of the year. And then on the rate side, right, we've talked a lot about fixed income. We had a somewhat view of short to intermediate was a better strategy coming into the year. Just as late as duration has got, or excuse me, yields have got much higher. We're seeing the 10-year close to 4.8, maybe it touches 5%. That makes sense for us to start to pull the duration out, right? So instead of focusing on 2 or 3 year maturities, 5-6 year maturities, that way we might be able to see some price appreciation on top of the higher coupon. So again, we're so grateful for your time. We appreciate the hour plus you spent with us, right? We have a couple questions in Q&A which we'll take offline, just simply from the standpoint of we're up against it from a time perspective. But thank you, folks. We look forward to a conversation in January, hopefully ending on a high note when we think about Q4 here in 2023.
Thank you.